Hello again, this is the part where we use examples in binary options trading with rising and falling wedges. Wedges are part of classical part or part of the classical side of technical analysis with together with head and shoulders patterns, with pennants, with bullish or bearish flags and so on. They were invented double and triple bottoms, ascending and descending triangles and so on. They were invented on the stock market, but they have pattern recognition approach on the binary options market as well, on the FX market as well, and currency pairs. The FX currency pairs are actually the ones that I use mostly in binary options trading. In the first part, we lay down the rules of a wedge. What makes a wedge? A wedge forms at the end of a bullish or a bearish trend. If it forms at the end of a bullish trend, it's called a rising wedge. If it forms at the end of a bearish trend, it is called a falling wedge. And wedges are reversal patterns. Therefore, when they form at the end of a strong trend, the price has the tendency to travel quite fast. So the idea is to wait for the wedge to be broken, to enter either on the short side or long side. In the case of binary options trading, either to buy a put option or to buy a call option, to measure the time taken for the wedge to form, project it on the right side, take 50% out of it. That would be the maximum expiration date, and therefore price should retrace in, let's say, 50% of the distance in 50% of this time. Remember, trading is a game of probabilities. These patterns show the probability or what the price should do after such a pattern breaks. So let's see a few examples both on these time frames and on some lower time frames on how to trade binary options with such patterns. So this is the US dollar Canadian dollar, the 4-hour chart. Remember, we need either a bullish trend before such a pattern to form. So no pattern here at the end of this bullish trend. Then we go on the previous one. This is a bearish trend, no wedge at the end of it. We go on the next one, the previous one, no wedge here either, no wedge here either, and so on. We do have a bit of a wedge formation right here if we take a trend line. If we take a trend line and we connect it from here to here, so this would be our 1 to 3 trend line. This would be our 2 to 4 trend line, and the wedge, the time taken for this wedge is this one from here to here. So what do we need to do according to our binary option strategy? It's very easy. To take this time, clone it, we project it on the right side. We project on the right side. We put a vertical line right in the middle of it. That would be our expiration date. So we effectively measure. We know this one in advance. Imagine that we don't know these candles here. We don't know these candles here. And we wait for price to break. We went for price to break the 2 to 4 trend line here. That would be the perfect striking price for this binary option. And of course, we go on buying a call option, and the expiration date would be, we effectively measure from here to here. There are no less than 35 4-hour candles. Remember, the price should completely retrace half of it in less than this amount of time. And when a wedge typically forms at the end of a strong trend, and therefore the reversal is quite aggressive. Rarely it comes back to the original breaking point in less than this time. So 34 hours expiration date, go long here or buy a call option, and just like that you are on the safe side of the market. And this is one example on the 4-hour chart. Let's go back in time to see if we find something else. Nothing here. You look only at reversal or when the market should reverse. Nothing here, nothing here, nothing here. But here we have a beautiful falling wedge this time. A falling wedge that if you draw a trend line like this, then the market or price comes and pierces the so-called 1 to 3 trend line. Remember, aggressive traders go and buy a call option when this happens here, even though this is a risky approach. A more conservative approach would be to wait for the 2 to 4 trend line this time, the 2 to 4 trend line to be broken, and then to measure the time taken for the wedge. This would be the whole wedge. We clone the time, or you copy the time, whatever. We paste it on the right side. This is the time. We go and take half of it. This would be the maximum, the expiration date that we will choose, and we could measure it. Let's measure the expiration date from here, from the moment that the 2 to 4 trend line broke, from here to here. We have 61 periods, so 61 periods times 4 hours. Then you have the maximum expiration date for what? For a call option that should have the striking price right here, and typically the price reverses 50% of the whole wedge in less than 50% of the time. 2 examples on one currency pair that didn't fail. Now, what's the beauty of it? The beauty of these patterns is that you can use it on any time frame, even the shorter ones, and set the expiration date accordingly using this simple rule. This is price and time in trading, and if you master price and time, then you master binary options. Thank you for being here, and have a great day. Bye bye.